Hello, and welcome to SDCERS pre-retirement webinar specifically for city employees affected by Proposition B. My name is Jessica Taylor, and I am SDCERS Communications Manager. I want to emphasize that this presentation is for city employees hired on or after July 20th, 2012, but before July 10th, 2021, except for sworn city police officers and police recruits. All other employees initially hired by the city during this period are what we will refer to as Prop B employees. As of the date this presentation is being recorded, Prop B employees do not participate in the city's pension plan. Instead, they have been contributing to a 401k style plan since they were hired, called the SPSP-H. However, Prop B has since been invalidated, and the city is currently in negotiations with relevant labor unions to figure out exactly how and when Prop B employees may begin participating in the city's pension system moving forward. In the meantime, this video is intended to explain how your pension would work if Prop B did not exist. Please note that this video will not explain your options regarding participating in the pension system, retroactive reciprocity, or purchasing service credit for time worked since July 20th, 2012. The reason for this is because we simply don't have any of that information yet. As soon as negotiations are finalized and we have more information about these topics, we will create and disseminate additional educational materials. So if Prop B didn't exist, you would all be SDCERS members. SDCERS only handles pension-related benefits. Please contact Principal if you have any questions about your city SPSP-H account. All SDCERS members belong to a specific pension plan tier based on membership classification, which is either general, safety police, safety fire, or safety lifeguard, and their initial hire date. If Prop B never existed, then all current Prop B employees would belong to the most recent plan tier according to their initial hire date. You can find the details of your specific plan tier by going to our website at www.sdcers.org. and then either going to Resources and clicking on Retirement Plan Summaries, or the shortcut is just to click on City in that Look Up Your Benefits box in the top right corner of the screen. Once you click on your corresponding membership classification and hire date, you can browse through all kinds of information specific to your plan tier, such as member contribution rates, eligibility requirements, retirement factors, and more. Even though you are not currently SDCERS members, we do encourage you to review the plan summary for the plan tier that you would belong to ahead of time. I have the plan tier that all Prop B general employees would fall into circled on my screenshot here. And then the plan tiers for Prop B fire and lifeguard employees is circled here. An SDCERS pension is a defined benefit plan. This means that when you become age and service eligible, you can retire and receive a monthly pension benefit that you will receive every month for the rest of your life, no matter how old you live to be. However, you are confined to the single monthly payment during your retirement. You will not be able to withdraw more or less than the monthly amount, and there is no such thing as taking out a loan against your pension. A defined contribution plan, on the other hand, would be like a 401k or your SPSP-H plan. With these plans, you make contributions throughout your career. Your employer may match all or part of your contributions, and it's all invested in the market. You have some control over the investment decisions with these plans, with the ability to opt for higher or lower risk investments. When you retire, you can begin withdrawing from this account, and you can withdraw as much or as little as often as you like. However, that does mean that you can run out of money before you die, and the funds in these accounts are subject to market volatility. A member's base pension benefit is calculated according to their age at retirement, their service credit, and their final compensation. We'll talk more about these elements later. But whatever this base benefit is calculated at on the day that you retire will never decrease. That initial calculation is the minimum amount that you will ever receive as your monthly benefit. On the contrary, your monthly pension benefit may increase up to 2% every July after you retire. and that's due to the annual cost of living adjustment, commonly referred to as the COLA. The COLA is determined by the Consumer Price Index published by the federal government's Bureau of Labor Statistics every year. Basically, that just summarizes how the economy did during the previous calendar year, whether there was any inflation or deflation. Lastly, you would also receive what's called a COLA annuity, a cost of living annuity, and that is a one-time increase added to your monthly benefit on the day that you retire, and it is entirely funded by your contributions, and again, calculated on the date of retirement. You may also receive another one-time increase called the surviving spouse annuity, but we'll talk more about that later. All I want you to know for now is that member contributions, which are deducted from each paycheck, are divided into 3 separate buckets when they come to SDCERS. The majority of a member's contribution goes towards funding the member's base pension benefit. We call those the normal contributions. The rest goes into a COLA annuity bucket and a surviving spouse annuity bucket. I'll refer back to these buckets a couple of times throughout the presentation, so I'm just laying the groundwork now. I mentioned being age and service eligible to retire a few minutes ago. For the purposes of this presentation, retirement is when you begin receiving your monthly pension benefit. And you must be age and service eligible before you can begin receiving that monthly payment. General members become eligible to retire when they are at least age 55 and have at least 20 years of service credit, or if they are at least age 62 and have at least 10 years of service credit. Safety members can retire a little bit earlier at age 50 or older with at least 20 years, or age 55 with at least 10 years. But what happens if a member leaves the city before they become eligible to retire? Well, it depends. If the member has at least 10 years of service credit when they leave, they just aren't age eligible to retire yet, then they are what we call a deferred vested member. This means that at some point in the future, wherever they are in the world, when they become age eligible, they can retire and begin receiving their monthly pension benefit from SDCERS. Of course, if they were to withdraw their contributions when they leave the city, they would then forfeit their right to receive a pension in the future. If the member does not have enough service credit to eventually become eligible for a pension when they leave the city, then they have the option of either leaving their contributions on deposit with SDCERS or withdrawing them. If they leave their contributions, the funds will continue to earn annual interest at whatever the current earnings rate is. Right now it's 6.5%, and they would earn that interest every year until they reach age 72, when they are required to withdraw the funds. In this case, the member would simply pick up where they left off regarding their pension benefits if they were to ever return to city employment. The member would also be able to establish reciprocity if they get a job at a reciprocal system, which we'll talk about in just a minute. The member would also have the option to withdraw their funds at any time after terminating city service. They could do this as a lump sum payment of their contributions and interest, which would be taxed at 22%, or they could roll over the funds to a qualified plan. If this member ever returned to city employment, they would be able to repay their contributions plus additional interest in order to pick up where they left off in terms of service credit and contribution rates. Also, withdrawing contributions means the member will not be able to establish reciprocity elsewhere. Reciprocity is the idea that you can move from an employer in one retirement system to an employer in a different reciprocal system without losing the service credit that you earned at the first employer. So for example, if you only earn 5 years of service credit at SDCERS while working for the city, and then you work for the county for an additional 5 years and you've established reciprocity, you would have 10 years total and therefore be service vested. In this example, when you become age eligible to retire from both systems, your retirement would be simultaneous and you would begin receiving a pension benefit from SDCERS based on your city service credit, and then a second pension benefit from the county based on your time worked there. There are very specific rules surrounding reciprocity, so please review our reciprocity fact sheet on our website for more in-depth information on this topic. Okay, so how is your pension funded? There are three funding sources: investment returns, the city's annual contribution, and then member contributions. The city does not match a member's contributions like it does for the SPSB-H plan. Instead, the city makes an annual payment to the SDCERS Trust Fund every July, and that amount that the city pays in any given year is determined by our actuary. But the most significant funding source is our investment returns. Our investments team is very important to us because 60 to 70% of a member's pension is funded by investment earnings. Member contributions are deducted from an SDCERS member's city paycheck every 2 weeks. So each pay period, the member should see a pre-tax deduction on their paycheck that looks something like my little mock paycheck here. Remember I said earlier that member contributions go into 3 separate buckets when the money comes to SDCERS. The majority goes towards the member's base pension, and the rest is divided between their COLE annuity and surviving spouse annuity buckets. The amount a member contributes is calculated as a percentage of their pensionable salary on that paycheck. And the word pensionable is important here because there are some pay types that are not pensionable and therefore not included when we calculate member contributions. Overtime pay is generally the most significant non-pensionable pay type. So if a member's paycheck is $2,500 and $500 of that paycheck is overtime pay, their member contribution will only be calculated as a percentage of the first $2,000 of base pay on that paycheck. The percentage that is used to calculate a member's contribution is according to their plan tier and how old they were when they first became a member of SDCERS. In general, the older a member was when they joined SDCERS, the higher their contribution rate will be. And that's because when you join at an older age, you typically have less time to contribute to your pension before you become eligible to retire, which means less time for your contributions to sit in our trust fund and earn interest. Most general members in the most recent plan tier contribute between 7 and 13% of each paycheck, while most safety members contribute between 15 and 20%. There are 2 main reasons for this difference. One, safety members have a lower age eligibility requirement. So if they can retire at a younger age, that means less time for their contributions to earn interest. And 2, safety members typically have higher retirement factors than the general members in this plan tier. So they have to contribute more in order to fund those higher benefits. Okay, so now we know how the pension is funded. Let's talk about how a member's monthly pension benefit is actually calculated when they retire. The base pension benefit formula is going to be the retirement factor multiplied by service credit multiplied by final compensation. First, we're going to talk about the retirement factor. This is a percentage determined by the member's plan tier and their age at retirement. Factors generally increase with retirement age, maxing out at age 65 for general members and age 55 for safety members. Each plan tier's retirement factor chart can be found in its retirement plan summary on our website, which we talked about earlier. This first retirement factor chart is for the most recent general member plan tier. As you can see, if you retire at the earliest possible age, 55, the factor is 1%. It then increases with every year increase in retirement age until it maxes out at 2.6% at age 65. Please note that even though it's not shown on the chart, all retirement factors are prorated in quarterly increments. So let's look at what the factor would be if you retire at age 60 and a half. You can see at age 60, the factor is 2%, and at 61, it's 2.12%. So if the age at retirement is 60 and 6 months, then the prorated factor would be 2.06%. Also, this plan tier has a benefit cap of 80%. That means that your pension benefit cannot be greater than 80% of your final compensation. We'll discuss final compensation more in a few minutes, but for now, consider it approximately equal to whatever your base salary is when you retire. Let's look at a couple of examples to demonstrate how this benefit cap works. So in this example, You are retiring at age 60 with a $100,000 final compensation, just to use nice round numbers. Since the benefit cap is 80%, your base pension benefit cannot be greater than $80,000. You will reach that 80% benefit cap when you have at least 40 years of service credit. You can follow the math here. Your factor at 60 is 2%, multiplied by 40 years of service credit, multiplied by your final compensation of $100,000. This gives you your maximum base benefit of $80,000. Now, if you retire at age 65 or older, you'll hit that cap once you have around 31 years of service credit. The factor at 65 is 2.6%, multiplied by a little less than 31 years of service credit, multiplied by $100,000, gives you an $80,000 a year pension benefit. Another way of saying this is that if you have around 31 years of service credit at age 65, your pension benefit will not increase no matter how much longer you work, unless you receive a salary increase in the future, because a salary increase is the only thing that can raise that benefit cap. Okay, now let's look at the retirement factors for the most recent fire and lifeguard plan tiers. The factors for these tiers starts at 2.5% at age 50, and it goes up 0.1% with each year increase in retirement age, maxing out at 3% at age 55 or older. These members will have a 90% benefit cap. Let's look at a couple of examples for you guys. We will once again say that your final compensation is $100,000, and in this first example, you are retiring at age 50. Your benefit cap is 90%, so your maximum base pension benefit will be $90,000. You will reach this cap once you have 36 years of service credit. The factor at age 50 is 2.5%, multiplied by 36 years of service, multiplied by $100,000 final compensation, gives you a $90,000 a year annual pension benefit. Now, if you retire at age 55 instead, then you'll hit that 90% cap once you've got 30 years of service. So follow the math one more time. The retirement factor at 55 is 3%, multiplied by 30 years of service, multiplied by $100,000, gives you a $90,000 a year benefit. So if you have 30 years of service credit by the time you're 55 years old, working longer will not increase your benefit unless you receive a salary increase in the future. Otherwise, you've already maxed out at a $90,000 a year benefit. Let's move on to the second element in the pension benefit formula, which is service credit. Every pay period that a member works for the city and makes their biweekly member contributions, they earn 0.038356 years of service credit. That number isn't overly important. The city is on a biweekly pay schedule, so working 2 weeks is equivalent to working 0.038356 years. By making that biweekly contribution, the member is essentially purchasing service credit for those 2 weeks. Normally, that is the only way to accrue service credit. In general, the more service credit that a member has when they retire, the higher their monthly pension benefit will be. However, the caveat here, of course, is that benefit cap that we just talked about. Remember that the most recent general member plan tier has an 80% benefit cap, and the most recent fire and lifeguard plan tiers have a 90% cap. So therefore, after a certain point, no matter how much additional service credit a member earns, their benefit cannot increase anymore because they've already reached their cap, unless, again, if they receive a salary increase. Bringing us to the last element of the pension benefit formula, which is final compensation. Final compensation for the most recent plan tiers is calculated as an average of your 3 highest years pensionable salaries. There's that word pensionable again. Remember that certain pay types are not pensionable, the most important generally being overtime. Note that the 3 years do not have to be consecutive. Theoretically, you can take a year's salary from 2010, a year from 2014, and a year from 2020, average them all together, if that's what would give you the highest average salary. Of course, most often, the 3 highest years' salaries will be the 3 years directly preceding the member's retirement date. There are exceptions, of course, but salaries generally increase the longer you work rather than going up and down. Okay, we're going to look at a few example pension benefit calculations now. Meet Sam Diego, who's our little mascot. Here, Sam is a general member hired sometime after July 2009, and he wants to retire as early as possible at age 55. His factor will be 1%. His final compensation is $60,000, and he has 20 years of service credit. His formula will be 1% times 20 years times $60,000, giving him a base pension benefit of approximately $1,000 a month. Of course, this does not include the cost of living annuity, the COLE annuity, or any future cost of living adjustments. Now let's see what happens if Sam waits 10 years to retire, now retiring at age 65. His factor goes up to 2.6%. We'll say his final compensation stayed the same just to make it easy, and his service credit is now 30 years. 2.6% times 30 years times $60,000 gives him a pension benefit of about $3,900 a month. So now he's making a little less than $47,000 a year in pension benefits, again, before the COLE annuity or any future COLAs are added. All right, we will quickly look at two similar examples for fire and lifeguard members. Here is Safety Sam, this time a safety fire member hired sometime after January 1st, 2012, and he wants to retire as early as possible at age 50. His factor will be 2.5%. His final compensation is $60,000, and he has 20 years of service credit. His formula will be 2.5% times 20 years times $60,000, giving him a pension benefit of approximately $2,500 a month before the COLE annuity or any future COLAs are added. Now, if Safety Sam waits 5 years to retire at age 55 instead, his factor goes up to 3%. His service credit is now 25 years. So 3% times 25 years times $60,000 gives him a base pension benefit of $3,750 a month, or $45,000 a year. Once again, before the COLE annuity or any future COLAs are added. All right, moving on from benefit calculations, let's talk about what happens if a member were to become permanently disabled at some point during their career, such that they are forced to retire. There are two types of disability retirements. The first is the industrial disability retirement. This applies when a member becomes permanently disabled due to their city job and their disability cannot be accommodated. This benefit is equal to 50% of the member's final compensation, and it is not taxed. There are no service credit or age requirements for the industrial disability retirement. However, please note that qualifying for workers' compensation benefits does not necessarily mean that you are eligible for an industrial disability retirement. There are different requirements and standards for each benefit. The second type of disability retirement is the non-industrial disability retirement. This applies only if a member has at least 10 years of service credit and they become permanently disabled such that they cannot be accommodated and their disability is not due to their city job. So for example, an off-duty car accident. The non-industrial disability retirement benefit is equal to 1/3 of the member's final compensation. But unlike the industrial disability retirement, this money is taxed. For more in-depth information about disability retirement benefits, please review our disability retirement fact sheet on our website under Resources in the Learn About page. But what happens to your SDCERS benefits when you die? Well, it depends on the circumstances. If a member dies while they are still working for the city, then they will leave behind one of 3 types of active death benefits. The first and most straightforward type of active death benefit is when the member was not eligible to retire when they died and their death was not caused by their city job. In this case, the member's beneficiary would receive all of the member's contributions and interest, plus up to 50% of the member's final compensation. This death benefit is a one-time lump sum payment. If the Workers' Compensation Appeals Board determines that the member's death was caused by their city job, then the industrial death benefit may apply. However, this type of death benefit is only applicable if the member's surviving spouse was named as their sole beneficiary or if the member has minor children. If the named beneficiary is the member's surviving spouse, then he or she will receive a lifetime monthly benefit equal to 50% of the member's final compensation. If there is no surviving spouse or the surviving spouse is not named as the primary beneficiary, but there are minor children, then this monthly payment will be paid to each child until they turn 18. If there is no named surviving spouse and there are no minor children, then the active death benefit applies instead. If the member was eligible to retire when they died, then the death while eligible benefit may apply. This benefit is equal to 50% of what the member's pension benefit would have been had they retired on the day that they died. However, it works similarly to the industrial death benefit in that it only applies if the surviving spouse is the sole named beneficiary or if the member leaves behind minor children. And it's paid in the same manner. So again, if there are no named surviving spouse, no minor children, then the active death benefit applies instead. However, if a member dies after they have terminated city service, but before they retire, the only death benefit that their beneficiary will receive is a refund of their member contributions plus interest. This is true even if the member was eligible to retire when they died, they just had not yet retired. Now, if the member dies after they have retired from the city, so they are a city retiree when they die, then the death benefits will be very different. The most significant death benefit a retiree can leave behind is what's called a continuance benefit. Whether or not a retiree is eligible to leave a continuance benefit and how the continuance benefit is calculated depends on the retirement benefit option that they chose when they retired, which we'll talk about in just a minute. But in a nutshell, the way that a continuance works is the member designates a single continuance beneficiary when they retire, and if that person outlives the member, then the continuance beneficiary will continue to receive a portion of the member's pension benefit every month for the rest of their life. So it is a lifetime monthly death benefit. The continuance benefit also continues to accrue the COLA every July, just like the member's pension benefit would have done. However, please note that the continuance beneficiary designation is permanent and irrevocable. It can never be changed once the member retires. So if the continuance beneficiary dies before the retiree, or in some cases, if the continuance beneficiary was the member's spouse and they are divorced when the member dies, then unfortunately, the continuance benefit would simply be forfeited. The other death benefit that all retirees leave is the $2,000 retiree death benefit and other payable monies. The $2,000 is intended to cover funeral expenses, and the other payable monies part includes any unpaid pension benefits that are owed to the retiree on the day that they died. This could include a prorated portion of that month's pension benefit. This benefit is a one-time lump sum payment, and the retiree can name as many beneficiaries as they want to receive it. They can name alternate and primary beneficiaries, they can name a trust as a beneficiary, and they can also change this beneficiary at any time, unlike the continuance beneficiary designation. For more in-depth information about all of our death benefits, please review the Death Benefits Fact Sheet on our website under Resources and Learn About. When you are ready to retire, you will have to select a retirement benefit option. This is another irrevocable decision that a member must make when they retire. There are 6 options to choose from: max benefit married, max benefit single, and reduced benefit options 1 through 4. First are the 2 max benefit options. We call them max benefit options for an obvious reason. They are calculated as the maximum base benefit a retiree can possibly receive without any reductions. Max benefit married is probably the most popular option among our married members. This option grants the maximum monthly benefit and allows the retiree to leave behind a 50% continuance benefit to their spouse without reducing the member's monthly benefit, regardless of the age difference between the member and their spouse. That means that the continuance beneficiary, which would be the spouse in this case, will receive a monthly payment equal to half of whatever the member's monthly pension benefit was when they died, and they will receive that payment every month for the rest of their life. However, please note that in order to choose this option, the member does have to be legally married or in a domestic partnership with their continuance beneficiary on the day that they retire. Also, in order for the 50% continuance benefit to be paid out, the member must still be married to or in a domestic partnership with the same person on the day that they die. Max benefit single is what I like to call the max benefit, because it truly is the greatest possible benefit that you can receive. However, note that the eligibility requirements for max benefit single are the opposite of max benefit married. The member cannot be legally married or in a domestic partnership on the day that they retire. They can be engaged, they can have a girlfriend or boyfriend, they can get married the very next day, but they cannot be legally married on their retirement date. This benefit is calculated the same way as max benefit married, but instead of leaving a continuance benefit, the member has the choice to either annuitize their surviving spouse contributions or take them back as a lump sum payment. So remember earlier, I talked about those 3 buckets, and the surviving spouse contribution was one of the buckets. The contributions that went into this bucket over the course of the member's career were ultimately intended to fund the continuance benefit after the member dies. However, with max benefit single, there is no continuance benefit, so the member gets to take back those contributions either as an annuity added to their base pension benefit or as a lump sum refund. And that is why max benefit single is the max benefit. It grants the absolute greatest monthly pension benefit when you include the refund of the member's surviving spouse contributions. So when someone selects a reduced benefit option, thereby voluntarily reducing their pension benefit, there are usually extenuating circumstances. This could be that they want to leave a greater than 50% benefit, continuance benefit to their spouse, or they want to leave a continuance benefit to somebody that they are not married to. In order to do either of these things, the member must choose a reduced benefit option. For example, it is not uncommon for us to see members come in with fatal illnesses, and they know that they're going to die relatively soon, or at least that their loved one is going to far outlive them. And these members often want to leave a larger continuance benefit to their spouse or other loved one. Sometimes members want to leave a continuance benefit to their child instead of their spouse, or maybe they're not married, they want to name a sibling, niece, nephew, or best friend as their continuance beneficiary. And sometimes members are actually required to select a reduced benefit option in order to name their former spouse as their continuance beneficiary due to a court order called a domestic relations order, or DRO, which arises out of a divorce. The point is that everyone's personal circumstances are different, and different benefit options make sense for different people. Also, before we get into more detail about each reduced benefit option, I want you to know that the size of the reduction to the member's pension benefit depends on 2 things. 1, the percentage of their benefit that they are leaving to their continuance. So a 100% continuance benefit would require a much greater reduction than, say, a 50% continuance benefit. And 2, the age difference between the member and their continuance beneficiary. The greater the age gap, the greater the reduction. Option 1 is the least often chosen option because it doesn't make a whole lot of sense financially for most people. The way it works is the member takes a reduced monthly pension benefit that they will receive for their lifetime, but if there are still funds left in their member contribution account when they die, meaning that their entire account hasn't already been used to pay out their benefits, then whatever is left goes to the beneficiary they designated. For example, a member who chose this option in the past had a fatal illness when he retired. He knew he wasn't going to live for more than a few years past retirement, but he didn't have a spouse or any family that he wanted to leave a continuance to. So instead, he wanted to leave everything he had to charity. He selected option 1, died a couple of years later, and the remainder of his contributions went to the charity that he designated. Option 2 allows you to leave a 100% continuance benefit. So whatever you are receiving as your monthly benefit on the day that you die, that is what your continuance will begin receiving for the rest of their life, plus any future COLAs that are added. We commonly see this option chosen when a member comes in with a terminal illness and wants to ensure that their spouse or other loved one is financially taken care of after they die. So they will take a significantly reduced monthly benefit for their shortened lifetime in exchange for leaving the maximum death benefit to their continuance beneficiary after they die. Option 3 leaves behind a 50% continuance benefit, just like max benefit married. But with option 3, you can name somebody besides your spouse as your continuance beneficiary. This option is often chosen by members who want to name their child, usually an adult child, as their continuance beneficiary. And finally, option 4 allows you to choose the percentage that you'll leave behind in the form of a continuance benefit. So any number between 0 and 100%. Sometimes a member has a court order, again called a domestic relations order or DRO, that comes out of a divorce and requires that member to name their former spouse as their continuance beneficiary and to leave them a specific percentage of their benefit as the continuance. Usually that number corresponds to the amount of time that the member was married while working for the city. Okay, so those are the 6 retirement benefit options that a member has to choose from when they retire. And this concludes our overview of how an SDCERS pension works. You can find additional resources and educational materials by visiting our website at www.sdcers.org and then clicking on the Resources tab. This blue rectangle on the right side of my slide will actually be on the left side of the website. We talked about the retirement plan summaries in the beginning. This is where you can find the details about your plan tier that you would join or that you would belong to if Prop B did not exist. I have the Learn About section expanded in my screenshot here. These are all of our fact sheets. I mentioned the death benefits and disability retirement fact sheets earlier. You can ignore the drop fact sheet that will not be applicable to any Prop B employees. There is a purchase of service credit fact sheet, which is something that we did not discuss today. Under certain circumstances, members may be able to purchase service credit for periods of time where they were not contributing to the pension system. However, we do not yet know exactly how purchasing service credit for Prop B employees is going to work. More information specific to Prop B employees and purchasing service credit will be provided once negotiations are finalized. Please review the Reciprocity and Termination and Deferred Membership fact sheets for more information about these topics. The Retirement Benefit Options fact sheet goes over the 6 options we just discussed. And the Form 1099 fact sheet is only relevant to SDCERS retirees. The FAQs page is a good place to go if you don't know what you don't know. You can scroll down, review the questions, and then expand any that you'd like to see the answers to. And those are the most relevant resources that we're going to discuss here today. So thank you so much for listening to this presentation and learning about SDCERS pension benefits. As stated in the beginning, SDCERS does not yet have any more information regarding the invalidation of Prop B and what options will be available to affected city employees. Please do not contact SDCERS until negotiations are finalized and you have been provided additional information. Because you are not yet SDCERS members, our call center will not be able to help you. Our current call center is designed to answer member-specific questions. Thank you.